We are still waiting for new hard data, but it is clear that the economy is heading for a significant growth slowdown and in many cases even a recession. At least that is the signal that leading forward-looking sentiment indicators bring. And also our nowcasting models, which adjust rapidly and translate the latest economic signals into growth forecasts, are now clearly in the red. We expect substantial growth slowdowns and technical recessions for European economies in the coming quarters. But again, we have to wait for hard data to confirm those growth scenarios, and the first flash estimates for the third quarter GDP growth are expected by the end of October. How deep the European contraction may get remains uncertain for now, and much depends on how the energy crisis evolves and whether we face critical and prolonged energy shortages. And this in turn depends on how harsh the coming winter will get, whether we manage to reduce sufficiently our energy consumption and consolidate our gas supplies. These gas stock reserves have been almost completely replenished, at least according to the latest data. Now, in any case, the moment of truth is approaching fast. Normally, gas stock reserves begin to be tapped from the end of October onwards, and from then on, stocks will begin to dwindle. The crucial question then is how fast? But either way, the economy will be impacted by the energy crisis. Declining purchasing power due to rising inflation and expensive foreign energy are weighing on consumer confidence and on overall demand, while high energy bills are driving up the production cost, especially in the energy-intensive sectors. Moreover, the fear of strong wage increases in still tight labor markets weigh on European labor-intensive sectors such as services, and this especially in Belgium. In contrast to previous crises, fiscal policy now faces the difficult task of absorbing the impact of the energy crisis alone. Monetary policy is now focused exclusively on aggressively fighting inflation. And inflation remains stubbornly high for now, even though the first signs of a possible turnaround are seen in the US. We expect policy interest rates in the US and the Eurozone to rise further quickly, above or close to the neutral levels, while financing conditions for the economy are tightening significantly. The so-called divine coincidence between monetary and fiscal policy is no longer there. Fiscal policy in Europe faces the almost impossible task of absorbing the impact of the energy crisis alone, and the fault lines between the countries with and without fiscal space are becoming clearer by the day. For example, Germany and France are spending between 3 and 4% of their GDP to absorb the energy shock, and the counter is still running, while other countries, including Belgium, are by necessity much less generous. A coordinated European policy does remain appropriate even in this crisis. But caution remains required. Not everything is permitted even in a crisis. And that is what the brand new British government experienced when it presented its new support and growth policy package. A package worth 6.5% of GDP with a rather contested tax reform caused considerable consternation and for the first time doubts about debt sustainability. The UK may have rid itself from EU control, but financial market discipline remains. And the financial storm that followed eventually forced the government to reverse its course, at least temporarily, in a rarely seen manifestation of the power of financial markets. In short, the European economies are now facing the moment of truth as winter approaches. And while monetary policy focuses exclusively on inflation, the full weight of absorbing the energy crisis falls on the shoulders of fiscal policy. Financial markets are forcing the British government into an unprecedented U-turn, and a little further from home, in China, the real estate crisis is worsening. A wall of worries, but perhaps there's one bright spot after all. The US economy is for the time being proving more resilient than initially thought.